All right, thanks for joining us. We're going to get started here. So to introduce myself, we have some clients here. We have a lot of people that are not clients joining us. So I just want to say thank you again for joining us. This is awesome to see this many people sign up. It's something that our clients have been asking for a long time, is saying, hey, I'd like to understand a little bit more about my financials, understand what should I be looking at, what should I be able to run myself. So that's great that you're able to join us. A little bit about me. My name is Hunt Demarest. I'm a CPA here with Parrinello and Associates. I've been with Parrinello for about 12 years now. And a little bit about Parrinello. So we're an accounting firm. We're based out of Maryland. Some of you might have met us at ATI. Some of you have obviously clients. But for those of you that don't know us, we are an accounting firm. We specialize in automotive repair and collision shops. So on a monthly basis, we work with a little bit over 400 clients, helping them not only get financials, but also to understand a little bit more about those financials. We work with clients in 48 different states, so across the country, you name it, we've seen it. I think what we can do is we provide a little bit more knowledge on, what you're going through as a shop owner than what most accountants can do. About 95% of our client base is automotive repair shops and automotive collision, so that is our focus, and that is our specialty. So getting into today, what we're going to do is kind of go down through here. We're going to take a look at some financial statements. I'm going to show you how to run some different reports and also what to look for on those reports. And so when we go through each of these reports, what we're going to look at is kind of get into my mind of what I would look at if I was going to look through these reports. This is a automotive repair shop. This is one of our clients. I've actually used their financials, scrubbed it and had it, and this is a conversation very similar to what I would be having when I went through these financials with our client. So we're going to be doing QuickBooks Desktop primarily is what's going to be the focus, and we're going to be running most of these reports out of. And I'm also going to show you how to run QuickBooks Online reports, the same thing on desktop. So a quick aside there on QuickBooks Online versus QuickBooks Desktop, because we hear this all the time. I'm on QuickBooks Desktop, my subscription is running up. Should I just make the move to online now? Or possibly even, a better situation, I'm not on any sort of QuickBooks now. What should I get, QuickBooks Desktop or QuickBooks Online? And so what we're recommending our clients right now is, obviously if you're starting fresh, there's no reason to go to desktop. Just go straight to online. It's what the industry is going towards. I think in 5 years, it's going to be very hard to get the QuickBooks desktop version whatsoever. For those of you that have went out and tried to buy the desktop version now, can attest to this, that it's very hard to get. QuickBooks is pushing towards this online model for a couple reasons. First one is, it's recurring income for them because you're just paying on a monthly basis. Now, the monthly charge for it is, for what we're asking our clients to get is roughly $15 a month, so it's not much. And what benefit that's providing you is you never have to worry about updates, you never have to worry about backups, and you don't have to worry about a server or anything like that. Wherever you are, if you have an internet connection, you're able to access your QuickBooks. So we love it. I would say at this point, about 40% of our clients, maybe a bit less, are on QuickBooks Online, and every year more and more people are going. So yeah, if you have any questions about that, how to upgrade to the online, we can help you do all of that. So let's get into this here. So we're going to start, like I said, on the QuickBooks Desktop version. I'm going to share this screen. All right, so you guys should all be seeing now what you're used to seeing on QuickBooks Desktop. So what I like to think about and how I like to do the analogy of your financials is if you were to take a look at your business is really a car. Your business is a car, it's a truck, right? And so if your business itself is a car or truck, what we want to do is keep it running optimally so it's going to keep on going and it's going to run forever. And so the first report that we're going to run is the profit or loss. And what I equate that profit or loss to is that's the engine of your business, right? And some of you might think, hey, what is a profit or loss, right? I've heard it's called a profit and loss. I've heard it called an income statement. But we here like to call it a profit or loss because at the end of the day, is it possible to have a profit and a loss at the same time? No. That's one of the most cut and dry things. You're either making a profit or you're not. Right? So that's why we call it a profit or loss. So if we're talking about the profit or loss being the engine of the business, what drives that engine or what keeps that running well It's the profits of the business, right? You know, I equate to a profitable business as a well-running engine. We equate a business that has a lot of loss or not a very profitable business to a poorly running engine. Can it keep on running? Yes, but it's a ticking time bomb that eventually it's going to let your car and your business as a whole down. So let's take a look at, what we'll say the first report that we're going to get into here is the profit or loss, and I'm going to show you how to run this one. So what we're going to do here is we're going to go up to reports. We're going to come down here to company and financial, and we're going to go over here to profit and loss standard. QuickBooks calls it profit and loss. We like to call it profit or loss. All right, perfect. So now that we get this pulled up, you'll see that we're looking at this month to date. The first thing I want you to do is we're going to go up here, and we're going to click down to last fiscal year. We're going to take a look at last year. All right. The next thing that we're going to do is we're going to collapse this. Why? Because take a look at this now. This is giving us a lot of information, but what we want to be able to use this report, what we want to be able to use our financials for in general, is making something that understands it. We're going to quickly look at it so that we can get some numbers out of it and we can understand it. If we get too complicated like this is, it's not really providing anyone a tool. It's just adding to more confusion and kind of adding to that dialogue of, financials are not for me. I'm going to leave that to someone else. We're going to kind of demystify this and educate you on this. All right, so we're going to go up here. We're going to click collapse. Now, I'm going to go through a lot of this stuff, and it might be faster than what most people can take notes on. But don't worry. After this webinar is done, we'll send you out a recording so you can go through this at your own pace. And replay stuff, anything that you might come across. If you have any questions about anything that we go through here, of hey, hon, I saw that you did this on your financials. I don't see that on my financials. Any of that kind of stuff, just reach out to me. I'd be happy to walk you through it. All right, so we got our profit or loss set up, and we got it condensed down, and we're getting closer to being able to use this. One thing that I'm still seeing here is we got some zero values on there. All right, like I said before, the whole key of this is to condense this and to simplify this. If there's a zero value on there, we don't need to see it. So what we're going to do here is we're going to go up to Customize Report. We're going to click this Advanced tab. And we're going to display rows that are non-zero, right? If it's zero, we don't need to worry about it. We don't need to see it. Perfect. So now what we got here is a simplified, condensed version of your profit or loss, all right? So you can see the first category on here we got is our sales category. You'll notice that we have labor sales, parts sales, sublet sales, shop supply sales. We got all of our sales accounts split out. Why do we like to do that? Because as we'll see next, we like to get into the cost of goods sold side so we can run some quick gross profit percentage numbers. Now, I know how a lot of people look at this is you would say, okay, I did $900,000 in sales last year. Let's scroll all the way down here to the bottom. Okay, I made $81,000. That might be the end of it. What we're going to walk through here and show you is kind of how, if I'm looking at these financials and what I did with this client, is how I would look at these financials. A couple of things that we come across, I'll tell you why we have it split out or why we like to see it. But this is kind of getting into the mind of an accountant of how I look at the numbers and how you should be able to look at your numbers as well. All right, so we already talked about we got these sales accounts split up, and we have the corresponding cost of goods sold accounts split up. So we got labor sales, we got labor cost of goods sold. We have parts sales, we have parts cost of goods sold. Sublet sales, sublet cost of goods sold. Now you'll see on here shop supplies doesn't have a corresponding cost of goods sold account. The reason that is some of our clients, this one included, feel like it's not worth it splitting out the shop supplies out of the parts cost of goods sold. It's such a minimal part of their parts bill, and they're buying it from the same parts suppliers that it's just not very easy to do. Again, it's not a big deal because when we look at shop supplies, we're looking at shop supplies as a percentage of sales. We're not looking to see if you're making or losing money on shop supplies. If you're in a situation where you think or you are losing money on shop supplies, we have a much bigger issue to take into a consideration. The last thing that you see on here is your service advisor. A lot of times we don't see service advisor up in cost of goods sold. A lot of times we don't even see any labor up in cost of goods sold. But for a repair shop, we need to see that service advisor up there as a cost of good, right? Because what is going on? What is that service advisor selling? Parts and labor, right? He is there for sales and sales only. So why would he not be a cost of sales? If the sales go away, our service advisor go away. So that's why we look at it and look at it that way. Both of these labor cost of goods sold category and the service advisor cost of goods sold, those are both loaded figures, right? So not only do we have our tech wages in there, we're having our tech payroll taxes, our tech insurance, all of that. Because what we're trying to do is we're trying to take a look, like I said before, at how much money we're making in each of these categories, and we need to know the true cost, right? QuickBooks is, at the end of the day, it's what you actually paid out to people, versus on the point of sale side, it's what you think that you made, correct? And so if that technician that you have out there in the shop is getting paid $20 an hour, he's truly costing you probably more like $27 an hour. And so the next thing that I'm going to do here, before I even take a look at anything farther, is I'm going to take a look and I'm going to run some of these numbers, right? So let's take a look at this parts. So we have $500,000 in parts sales and about $325,000 in parts cost. First thing I'm going to do here is I'm going to run that and say, okay, we're making about 35% gross profit for parts. That's low, right? We all know that that's less than what we should be getting on our parts cost of goods sold or our parts sales. I'm not even going to get into why we're low until I do one thing. I'm checking out against your point of sale, right? Because one of the biggest things that we see when we get new clients is that their point of sale, their Mitchell, their RO writer, they think that they're getting one profitability. They think that they're getting one parts gross profit margin, but in QuickBooks, it's actually much lower. So while they think that they might be getting 50% because that's what their RO writer is saying, in actuality, in reality, they're only getting 35% gross profit margin. And so the first thing before we get into anything else is we need to figure out why those two are different. And that's one of the most important things. Because for this client, he has a service advisor, so he's not on the counter. And his responsibility or his expectations for that service advisor is that you are going to get me the proper profit margin based on what I've set up in my point of sale, right? We have parts matrices, we have labor matrices, and we're expecting that to do their job. The service advisor, it's his job to sell the work. If all those systems are working correctly, he's selling a job, it's calculating the correct gross profit margins to charge for labor and parts, then the money should just fall in line. But if we have a service advisor that thinks that he's knocking it out and he's getting 50% for parts when we're actually getting 35%, we have a disconnect there, right? We have something going on because at the end of the day, QuickBooks is what we paid out, right? We actually paid that cash out. We actually got that cash in. Whereas our point of sale is what we think that we're making. So we had to figure out why. That's kind of the million-dollar question here and something that we struggle with a lot. But, a couple of different places that we need to look into on why those are different or why we see that those are different. The first one being is that we have a pricing issue. We see it less and less now because of all the electronic order and electronic catalogs. But short and simple, you are paying more for a part than you think that you're paying, right? That's one reason. Another reason is that you don't have parts getting billed out to customers' tickets. And this is the one that we see a lot. So you're paying for a part, you're paying for a water pump, you're paying for a radiator, but you're not actually invoicing that onto a ticket. There's two reasons. Possibly you guys are busy and the technicians just aren't updating the service advisor, updating the ticket of, hey, boss, we ended up having to put this on the car. And so that car rolls out with a brand new radiator and that customer got that for free. Now, even worse, sometimes we have these parts and they're coming from the vendor and possibly they're walking out the back door. I know no one likes to think about it, but we have to look at all of our different, possibilities of why we have a discrepancy between the two. Once you figure out why we have the discrepancy between the two, hopefully that fixes your margins because you're figuring out why, or maybe then you can update your margins and then work on improving them. But until you figure out why those two are different, there's no reason to go any farther than that. All right. Same with labor. Labor is very similar. If in your point of sale, labor is probably in there an unloaded rate. The guy's probably in there $20 an hour. Your point of sale also isn't including any efficiency numbers. Some of them do, but most of them don't. We're not as worried about those two matching because it's not money leaving the door. It's just an accuracy thing. Obviously, we want all of this stuff to match, and we would love it to be all 100% accurate and 100% matching. But my primary focus is parts. If you can get your parts matching 100% between your point of sale and QuickBooks, perfect. Move on to labor so that we're looking at accurate reports every single time. But parts is the big one that you got to take a look at. All right, so moving on these financials. So like I said, that's what I'm looking at. I'm looking at my labor, I'm looking at the sales category, I'm looking at the cost of goods sold, making sure everything looks good, making sure stuff is jiving, comparing that to the point of sale. So the next thing that we're going to do is we're going to dig down in here to the expenses, right? And we're going to figure out, okay, we got some profit margin issues. We maybe have a disconnect between a point of sale and the QuickBooks, but let's take a look at the overall expenses. So when we're looking at expenses, what I like to do is I like to look as a percentage of sales. And so I'll show you how to add the percentage of sales here before I kind of go into why we end up doing that. So if we go up here to customize report, we're going to click here, add subcolumn for percent of income. And now we got this nice column on the right-hand side here that's going to give our percentage of income. So if we're looking at administration costs, I'm not looking at $20,000. I'm saying it's 2.2% of my sales, right? I'm not looking at advertising as $5,000. I'm saying, hey, my advertising is 0.5% of my sales. Why do we do that? Because if someone calls me up and they say, hey, Hunt, I'm spending $5,000 a year on advertising, is that too much or too little? It doesn't give me any information, right? Because then what? We have to follow up. Well, how much are your sales? What are you looking to do? If someone says, Hunt, I'm spending 3% of my sales on advertising, you know what? That's pretty much in line. I know what we're talking about. I don't care if it's a $5 million business or a $500,000 business. We know that's in the ballpark of something that's reasonable. As an average, our clients are spending about 3% on advertising. We say that the sweet spot is somewhere between 3 to 6%. Anything above that, you're kind of getting into a risky territory. But, that's no thing is set in stone. I have a client that calls me up and they say, hey, Hunt, I'm spending 9% of my income on advertising. Is that too high? What I would ask them is I would say, hey, are we in a growth period? Are we still growing this business? Are you trying to drive new customers in? If they say, yeah, I'm 2 years into this and we're growing every single month, but I need to get more and more customers. The 9% makes complete sense, right? The numbers tell a story, but also sometimes the numbers just tell the start of a story and we need to get a little bit farther into it. Now, if that same client says, hey, Hunt, I'm spending 9% of my advertising. I'm not looking to grow my business whatsoever. I'm just doing that to maintain. Then we got to really look at something because something's not right there. There's no reason you should be having to spend 9% of your sales to just keep the current clients that you have. In actuality, what we see a lot of times is we have clients on two ends of the spectrum. We have clients that spend zero money on advertising, or they fall into that 3 to 5% range. Right. And so then what ends up happening is an overall average of all 400 of our clients, usually end up in that 3%. All right. So another thing that we're doing by looking at the percentage of sales is that we're looking at expenses. Is it even worth us worrying about? Right. So let's take a look at this category called employee appreciation. Right. It's $3,000. What I hear way too much is, hey, I want to set a budget for my shop. Right. I want to cut expenses. I want to make more profit. And a lot of times people are focusing on the wrong things, right? They're looking at fixed expenses. We're going to cut fixed expenses. In reality, repair shops don't have a lot of fixed expenses that I would say are discretionary. Everything that's in your fixed expenses is probably there for a reason. Sure, you could trim out some stuff here and there, but is it really worth your time or effort? Or is there going to be some unintended consequences to that, right? So employee appreciation, it's 0.3% of our sales. It's $3,000. Let's say that we're going to look into that. First of all, I probably would say let's not even worry about that because it's such a low percentage of our sales, right? What I would say is let's go look at something that's a bit bigger. So if we go down through here and we say, okay, we're not going to worry about rent. We're not going to worry about professional fees. Utilities, that's a good one. So let's look at our utilities. Our utilities is 2%. So client says, hey, Hunt, you told me to not worry about stuff that's a smaller portion of my overall net income. I'm going to worry about utilities, right? That's 2% of my net income, or that's 2% of my gross sales. How do we reduce that? I want to reduce that. Well, let's look at how you would reduce that. If you maybe could lower the heat in the wintertime so the shop wasn't as hot in the wintertime, okay, you're not going to be able to call up and get a new rate from the gas company. You're not going to be able to call up and get a new rate from the electrical company. Those are set in stone. But what's going to happen is if we start being cheap on the heat, it's now going to be colder in the shop. You think the guys are going to be as happy? You think the guys are going to be as productive, working on those cars? No, I don't think so. Same thing in the summertime. A lot of our clients have shifted and they actually have air conditioning in their shops. And they said it's a huge productivity increase in the summertime because no one wants to be out there at 85, 90 degrees, even more in the summertime, working. You're just not going to be as productive. That's proven science. So what happens if we start trying to pinch pennies and try and save money on that? Okay, yeah, we might be spending, $2,000, $3,000 less a year on utilities, but keep in mind how much your labor rate is. And do you think that you're losing that many labor hours by doing that? Probably, right? Also, just think about how much your time is worth. If you're going to go down through here and you're going to say, hey, I'm going to start penny pinching on office supplies. I'm going to start penny pinching on, maybe some of the subscriptions that I do. Is it really worth it in the end of the day? Are you really going to save money? What we usually end up seeing is that for an auto repair shop is if you start reducing expenses one way, it kind of just shifts, right? That money doesn't usually ever fall to the bottom line. It just kind of shifts around. And a lot of times, just like I said, is, hey, if we start shifting down some fixed expenses, you could have unintended consequences that maybe the profitability is suffering or maybe the gross profitability is suffering. Now, that's not to say that if you're going to look down through here and, there's expenses to be cut, sure, but just keep in mind that, there's always, there's two sides to every coin, and there could be unintended consequences to what you do. So if we're looking at this, one other big things that pops up here is rent, right? It's the highest expense on here, and it's at 5.7%. 5.7% is actually dead on to what our clients are averaging as a percentage of sales spent on rent. Now, rent is a big one. Rent, we say, needs to fall into the 6 to 9% of overall sales. That's kind of the sweet spot. Now, we do have some clients that are in expensive areas, possibly, out in California in the Bay Area, where we're seeing 12 to 14% of their sales go to rent. Now, but a lot of those people that have successful shops there are blowing it out somewhere, right? They're paying more than their average counterparts for rent, but their parts margin is possibly much better and their labor margin is much better than other people. It's not to say that if you're outside these range, you can't make it work. But in order to be as profitable as some of the other people, you need to make sure that something else is counteracting that. There's something else that's making up for that. So going down through here, when I'm looking at this, I'm looking at it as a percentage of sales. I'm just looking at stuff that jumps out. Nothing's jumping out at me, right? Rent looks okay. Rent's in line. Salary looks a little bit low for the officer, but it's looking okay. Bank service charges is a little bit high, but a lot of that's credit cards. Not a whole lot we can do. Administration costs is just his bookkeeper, so that's okay. Professional fees, as long as he's getting the value out of that, then perfectly fine. This is all about, not about what absolute money you're spending on this. It's what value is it providing. Hey, part of our fees is in that professional fees. If we're providing value, we're doing tax planning, we're saving you money on taxes, we're educating you on how to make more money, then fine. If you're working with ATI or another coaching company and they're driving your profits up and they're driving your sales up, then awesome. That's money well spent, and you'll spend that 5 times over. What we're looking at here is just, not the dollars, we're looking at the percentages, we're looking at the value that these numbers are giving you. All right. So when we come down here a little bit, this is the number that we should be looking at, this net ordinary income, right? Because what is it factoring in? It's taking our sales, it's taking our cost of goods sold, and it's taking our expenses, right? And what we come up with, $91,000. A lot of people are looking down here at this bottom line, but this bottom line takes into consideration some other income and other expenses. So this $91,000 is not taking into consideration rebates, which I think for this person was actually vendor rebates. The reason we have that down in other income is that's not your day-to-day operation, right? Your day-to-day operation is not out there to get vendor rebates and returns and stuff like that. It's just stuff that happens in a normal course of business. It shouldn't be relied upon. It's just gravy money, right? Another things we got going on here is we got some other expenses. Officer life insurance and penalties are not deductible expenses, not critical for the business to be in operation, and something like penalties we shouldn't hopefully ever see. So we pull those down other expenses. Donations and contributions, again, it's coming out of the business. We'll deduct it on the business tax returns, but it's a discretionary expense. All right, it's something that you choose to do with your profits. It shouldn't be factored into the actual profits of your business. And then we got here depreciation expense. All right, depreciation expense, as you guys know, is not an actual cash expense. It's just your accountant or me recording the depreciation that you've incurred for the year for your fixed assets. So all in all, if we're looking at this and we're saying, all right, we got $914,000, which translates to about $91,000 in net income. We're looking at the whole year. All right. And so if we're trying to get snapshots, if we're trying to review the end of the year, okay, cool. But one of the things that I like to do is I like to see, well, let's see how we got there, right? There's 12 months in a year. Let's kind of see what the track record looked like for the 12 months. Do we have dips? Do we have high spots? Do we have low spots? Is there possibly some months we need to look at where we can learn something from? And so what I'm going to do is I'm going to show you how to sort this, showing every single month. So first thing we're going to do is we're going to come back up here. We're going to take off this percentage of income. Right? So when we look at this, like I said before, the biggest thing is we're trying to simplify this. We're not trying to overcomplicate it. If we're going to have a percentage of income on every single month, it's going to make this report huge, and it's going to make it kind of confusing to read. So now that we got the whole year, we're going to go back up here to show columns, and we're going to sort this by month. All right? Now what we have is we have a timeline of what happened for the entire year. Right? We can see our sales trending, which you might have already seen in your point of sale. But more importantly, down here, we're seeing our income trending, right? As a lot of you know, sometimes there's no rhyme or reason to why you have a good month or a bad month. And this client is, pretty much evident of that. We have a good month, bad month, good month, good month, good month, then a bad month. Sometimes there is no forecasting to this. However, what we'll see is a lot of our clients have a very cyclical and seasonality to their business. A lot of our clients that are places that are really affected by the snow in the winter, they'll see that their January and February, they're scraping by. They're just trying to survive. And then March, April, May, they're building it back up, right? Once people start to thaw out and once people start to come out and get some money. Once people start to come out of their house and, actually see the sunshine, start spending that money. And we have another clients, that are in the exact opposite. They don't have really seasonality of their climate because they're possibly in warm weather places, but they have possibly snowbirds. And the time when the snowbirds are coming or going is possibly a slow time to their business. And so this is where you'd be able to kind of see that. Another thing is we have clients that are possibly around university and colleges where, the summertime is extremely slow for them. What I like to use this for, and I like to tell my clients to take a look at, is if we're looking at, we're seeing July and August are always slow. And I'm asking them, hey guys, why do you think July and August is slow? And they tell me, well, hey, we are in a college, we're on a college campus. So July and August are kind of slow for us because, 75% of the population is gone. What can that do to me as a business owner, or what would I be thinking in the back of my mind? Coming into May and June, am I looking to go out and buy a new piece of equipment? Am I going out to, take that bonus or take that distribution? No, May and June, I should be stocking up and having my cash reserves because I know that July and August are going to be a bit of a downturn, right? And anytime we have 2 bad months, sometimes that doesn't hit immediately because the bills are delayed a bit there, right? And the collection sometimes is delayed a bit there. So if we have 2 bad months, in actuality, it's going to take about 3 to 4 months for that full cycle to hit and that cash to come back to a normal level. All right. And anytime if those months stretch out, that cash is going to be pushed farther and farther ahead. So the big thing there is, we want to just be looking at it and just understanding our business, inside and out. All right. When are we hot? When are we not? And, something like this client, I can't really pick anything out. They don't really have a whole lot of seasonality. It's just what we see as a typical repair shop of, sometimes it's up and down swings here. So let's take a look at something if we want to look at it a bit more condensed. So this is pretty specific. We're looking at every single month and trying to see a trend. And I just don't really see a whole lot of trends here. Let's take a look and see if we can look at it on a quarterly basis. So what we're coming up here, and we're going to go here, and we're going to click to sort this by quarter. All right, so now we have first quarter, second quarter, third quarter, fourth quarter, and that gets us to the overall year. If we scroll down here to the bottom, we can see that the quarters stayed somewhat similar. They had actually a very good fourth quarter. But if we look at the sales, you can see that we're growing. We're at 202, 206, 242, and then 262. What I'd be looking to see out of this is I'd be looking to see for that money to just keep on going in that direction. Hopefully we can follow fourth quarter 2018 with a real strong first quarter 2019 and just keep growing those sales and building on that. But one of the things here is we're just, again, just trying to dig into those numbers a little bit more. We're trying to see what went wrong. A lot of times we say, hey, we had a pretty good year, but I just feel like I left something out there. And we'll take a look and we say, yeah, you blew it out of the water first quarter. Third quarter was awesome. Fourth quarter was really good too, but you lost it all in the second quarter. And if we can dig into that and see what happened there and see if we can get an explanation on it, we can learn from it and hopefully avoid those in the future. Now, sometimes you'll see, maybe you had a personnel issue, you had a technician out, or, a transfer of technicians or possibly a service advisor, and we say, we know the second quarter just died out. We had staffing issues. We tried to hire 3 different technicians before we finally found one that stuck. But sometimes there isn't really, or they didn't even realize that the second quarter was that bad. And we can go back to the second quarter and kind of dig into it a bit more and use that as a learning experience. Where did this go right? Where did this go wrong? So that we don't make these mistakes in the future. All right. So that's kind of digging into the year, and that's about as far into it as I'll get. Once we start getting some questions back and forth from the client, we might start digging into a little bit more into these expenses of, hey, I didn't think I was spending that much. What's going in here? Maybe we're reclassifying some of the things. Oh, I don't want to see that office supplies. That's really a dues and subscription or something like that. The next thing that I would probably go here and take a look at is I'm going to compare 2018 to the previous year. All right. So in order to do that, I'm going to come back up here. I'm going to switch this back to total only, which looks just like what we were looking at before. I'm going to come up here to customize report. I'm going to click previous year and dollar change. Now, you can see we can do percentage change there. I don't like doing percentage change on this one because some of the numbers, if you're going from $200 to $400, yeah, it's a 200% change, but it's not really something that we should be looking at. I'm looking at how much cash is different from this year to last year, right? So again, if we're looking at this, we say, okay, we have $914,000 in sales this year. It's down from $938,000 last year. All right, not the direction that we're moving in. Now, there is some positive and negatives to this, and we got to dig into it a bit more. If I'm looking down, the labor cost of goods sold went down. This client actually fired a technician. So if we're keeping that in the back of our mind, we're saying, hey, you actually lost a whole technician, but your sales only dipped down a very little bit. Either the guys that around him kind of stepped up and their productivity increased, or the guy that you let go of just didn't have the very good productivity anyways. Now, one thing I would be worried about here, and one thing I'd look at, is this. Under parts cost of goods sold, you can see that the parts cost of goods sold went up. So parts sales went down. Parts sales went from 529 down to 502, but our parts cost of goods sold went up. All right, like I said before, what I'll be looking at, the first thing I'd be doing on that, I'd be pulling the point of sale and seeing if that's giving me the same information, right? I'd be looking for that point of sale to say, hey, are we having that same gross profitability drop on the point of sale that we're showing in QuickBooks? If we are, then we need to start digging into it and seeing, okay, what's going on? If we aren't seeing that same drop on the point of sale, like I said before, we got to figure out what's going on. We got to figure out what that disconnect is before we can try and fix that. All right, so that one thing would worry me there. Another positive that I see here is now we spent $48,000 more on Service Advisor, but now this guy has a service advisor. This client, one of his keys to succession and keys to, the long-term success of his business is he knew that he had to get off of the counter, right? He had to hire someone. He didn't want to be dependent or the business to be dependent on them to be there on a day-to-day basis. And he knew that the only way to do that was to get someone on the counter full time. So yes, we're spending $50,000, but $50,000 well spent, right? He's given some of his life back and hopefully spending less and less time in the business. So if we're looking at this overall, if we're just looking from a general overview is, okay, sales went down 23,000. Let's take a look. Our profit only went down 3,000. Okay, if we're just stopping there, we're saying, okay, it wasn't too bad. Now, a couple of things that I want to look at here is, now we're only down $3,000. You can see that his salary went down $42,000. So that's $42,000 less money in his pocket, right? Now, if you were paying yourself rent and it went from 96 down to 52, that means that that's another $44,000 that's out of your pocket. So if you're just relying on this net income, it's not telling you the whole story. Now, this client, he doesn't rent from himself. He actually rents from someone else. So that was just a completely different situation. But he does have $42,000 less in his pocket. A lot of these other expenses, you can see they went down, went up. Like I said before, a lot of times when you see fixed expenses, the overall amount stays very similar. It just kind of shifts around, based on what the business needs in that given year. So, even though that the client took $42,000 less in payroll, you can see essentially what he did is he said, you know what, the way for me to afford a service advisor, I'm going to take a bit of a pay cut. And what I would be talking here and what I'd be planning for here is saying, hey, let's start driving this business. Let's start leaning on our service advisor and our technicians more to drive that sales up, to drive that profitability up, so that I can go back to the salary that I was making before and even make more money, right? Just grow this business sales-wise and profitability-wise. So yeah, that pretty much wraps up what I would look at on this. You can only look at these numbers so much, and there's only so much that we can get out of them, but that's going to be more than enough to kind of get a ton of homework to go back to and say, hey, these are the stuff I want you to look into. These are the goals that I want to set, and we're going to check into it and see what you came up with and how's it going. So that kind of concludes the profit or loss side of things. Like I said, it's the engine that's driving the business. If we're looking at your business as a car, this client here has definitely some work to do, but at the end of the day, they're making money, right? They're paying the bills, they're putting some money aside. Sure, they got room to grow, but every business out there has room to grow. What I'm going to do now is I'm going to take a look and I'm going to show you how to do this same thing on QuickBooks Online real quick. All right, so we know how to do it on QuickBooks Desktop. How would we do the same thing on QuickBooks Online? So let's go over here to QuickBooks Online. All right, so this is probably similar to what you're used to seeing on your QuickBooks Online. This looks a bit different because this is the accountant version, so we have some of this Your Practice stuff up here, but this Your Books looks exactly the same as what you're used to seeing. So what we're going to do here is we're going to click on Reports, and like I said, we're going to go to Profit and Loss. Just like before, this is looking at last month. We're going to switch this to last year, right? We're going to take a look at 2018. Just like before, we don't want to see anything that's zero, so we're going to take a look and we're going to look at all the non-zero accounts. All right, we're going to run this report. Perfect. So we're getting a little bit closer. You can see here, we still got a lot of stuff going on here because it's still expanded. So what we're going to do here is we're going to collapse this. All right. And now that's looking exactly like the base of what we start with on QuickBooks Desktop. Another thing we were looking on QuickBooks Desktop is we were displaying different months. So all the stuff up here on QuickBooks Online, if we want to look at it by month, we're just clicking there and we're clicking Run Report. If we want to look at it by quarter, the same way, Run Report. And if we want to look at a year-to-year comparison, we're going to come over here and we're going to select another period to compare. We're going to do previous year, dollar change. All right, and run this report. Everything that we can do in desktop, we can do in online, just maybe a little bit different layout, a little bit different ways of doing anything, but they're very, very similar. So the last thing I want to show you on this is I'm going to go back to the base of what we started with, right? Or it's just the profit and loss. And we're going to add in these percentages. So we're going to go back here and we're going to add in this percentage of income. Like we were talking about before, this is the base where we start all of our decisions on a profit and loss. So it doesn't matter if we're looking at last month, last year, we're still always going to have these percentages on there so we can take a look at those expenses. So what I usually do and what I tell my clients to is once we have this set up, we can run this every single month and we can just change these periods, right? So what we're going to do here is we're going to save this customization, and we're going to call this a profit or loss with percentages. And we're going to click Save. Now, every time that we come in here, if we go back to Reports, you'll see under Custom Reports, profit and loss with percentage. You click on it, it'll run it, and you'll be back to where you were. No more worrying about having to redo that report every single time you open it up. It's just going to be there. All right. So we switch back over to the desktop version. I'm going to tell you how to do the same exact thing on there. All right. Like I said before, we're going to get rid of this. We're going to go back to square one. We're going to do the percentage of income. And we're going to click here. We're going to memorize it. Profit or loss with percentages. All right. We click OK. Now, if we go to Reports, Memorize Reports, there it is. All right. Right there, right up front, easy to get to. Don't have to worry about recreating this report every single time. You know, we memorize that one, but I have a lot of clients that say, hey, I'm gonna make the one that splits it out by month, memorize that and just call it last year by month. I'm gonna make one that splits it out by quarter. I'm gonna call it last year by quarter. You know, and every single time it's gonna update that, and you can go into that and you're gonna start it there, and you don't have to worry about messing around with one. You can have all your changes already made, so you can easily pull that up. All right. So that wraps it up for the profit and loss side of things. All right, and so the next thing that we're going to move into, and kind of the final report that we're going to run here, is what I call the dashboard, right? If we're thinking about your business as a car, we're looking at what do you use the dashboard of your car, or, you know, the dash panel, your gauges. You're looking to see how fast you're going, right? You're looking to see if there's any warning lights coming on, and that's exactly what I think a balance sheet is. You know, a balance sheet you should be able to look at and get a snapshot of what's going on right now, right? Because in a car, your speedometer doesn't tell you what you did, you know, 3 miles ago. It's telling you what's going on right now, and that's exactly what a balance sheet is doing. Same way a car is, if you have a flat tire, it's blinking in your eye. A balance sheet's saying, hey, take a look at this account. Something's going on here. And so what we're going to do is show you how to set one up and what to look on the balance sheet. So if we go here, we're going to click on reports. We're going to close this one out. Click on reports, company and financial, and go down here to balance sheet standard. So just like on the profit or loss, we like to set up the balance sheet in a certain way as well, and what we'll get into a little bit later to show you why we do this. So we're going to click here. We're going to do last year. We're going to customize this report, and we're going to compare the previous period and the dollar change. All right. Again, we're going to collapse this because what we're looking for here is simplicity, right? We're looking for ease of reading. And now what we have is 3 columns. We have December 2018 and December 2017, and then the dollar change from the two. So remember, what we're looking at here is a snapshot. Now we have a snapshot of December of last year to December now. The income statement was showing me the same thing. It was showing me what's going on over that year period. This is showing me what the overall business and the overall health of the business is looking like at those 2 periods and how much it changed. So if I'm going down through here and I'm taking a look at different categories or different expense or different accounts, I'm going to tell you what I'm looking at, right? One of the first things I'm going to look at here is I'm going to look at the checking account. What are we looking at the checking account? Like I said, think of this as your dash, right? We're looking to see if warning lights are popping up. We're seeing if something is going wrong that we need to be worried about. And so one of the first things that we're going to do is we're going to look at the bank account and see what's going on there. All right. So the first thing that I'm looking there is, okay, it's showing that we have $6,200 on there. If I'm looking at my online banking and I show that I have $20,000 in there, we have a big disconnect there. All right, we're looking for something that's vastly different. Now, if we're looking and there's $7,000 in the online bank account and there's $6,200 here, we're okay with that, right? We're not worried about that because QuickBooks is factoring into a lot of things. Possibly there's checks that have not cleared out of your bank that you've already written out of QuickBooks. Possibly you have deposits in transit that just haven't, they haven't hit there yet. All right. So next thing we're going to look at here is this deposit clearing account. What's that deposit clearing account? That's your undeposited funds. That's your cash clearing. That's your credit card clearing. It's money that you've received from customer that has not hit the bank account yet. It's a very hard number to kind of peg on because it's a moving scale. It's moving all the time, right? It's not that easy to pin down and see what's going on. But what I'm doing to make sure that we have everything in line is I'm making sure that it's not growing, right? I'm making sure that it's not getting huge all of a sudden. I want to stay in a similar category and stay about that $3 to $4 grand for this client. If I see that hop up to $8,000, $10,000 and just keep on growing, I know I have an issue. Why? Because we have sales that are coming in that for some reason aren't hitting the bank account, and that's never good. Next thing that I'm doing here is I'm taking a look at this AR. What am I going to do with AR? AR should be able to tie directly back into that point of sale. If my point of sale is showing that I have $85,000 in AR and this is showing I have $71,000, we got to disconnect somewhere. Or if we have the opposite, let's say that we're only showing $50,000 of good AR in our point of sale, but this is showing $71,000. We have a $20,000 difference. If you have $20,000 in AR that's too high, that means at the end of the year, you could be paying $20,000 or tax on $20,000 of income that you really shouldn't. Right? So we're not only doing this for our day-to-day stuff, we're doing this to make sure that the end of year numbers are correct, making sure that you're, day-to-day numbers are correct, making sure that you're understanding what to look and what to jump out at, what to question, right? We got an intercompany loan here, not a whole lot going on there. We want to make sure that if you have two sets of books for your intercompany, that this operating entity is matching what you have on your other entity. All right, we got some money going back and forth and stuff like that. Inventory, the same way as AR. We're making sure that that's right. If your inventory is too high on your books, it means that you're not getting the deduction for stuff that's sold and you could possibly be paying too much in tax. No one wants to do that, right? At the end of the day, we're all here to pay as little as possible or as little as legally possible on your taxes. So down here, when we look at fixed expenses, what are we looking for here? I'm looking to see that assets that I purchased are being recorded on there, right? You know, stuff like a big equipment purchase that you go out and write a check for, those usually get caught because those are going to jump out. You have a $20,000 check to someone's probably going to see that. But what we see missed a lot is, let's say that you go out and you get a lease with Snap-on, you get a lease with, Great American Financing, and you have a monthly payment. If you don't tell your accountant or tell your bookkeeper to get that set up in there, it's possible that you're not getting the expense for it, right? It's possible that they're just deducting that lease payment on a monthly basis. What we would like to see is that set up as a fixed expense, because if you have a lease to own type situation and it's set up as a fixed expense, we're able to take that deduction all in the first year instead of spread out over the life of, the 60-month financing that you might have. So we're making sure that that's on there, making sure they're asking questions. Small tools and stuff like that, you can see that tools here, we say over 2,500. If it's less than 2,500, we're probably just going to expense that. But still questions to be asked. Hey, I bought a number of tools. Where is that? This whole thing is to get you to understand your numbers more, to get you educated. And the best way is to ask questions. Hey, why did you guys put that on as a fixed asset versus, just taking the expense for it? Or why did you put that on as expense versus, capitalizing and putting it on as a fixed asset? These are all conversations that you should be having and that we love to have. I've never told someone, hey, don't worry about it, because at the end of the day, you should be worrying about it, because if you don't, who will? This is your financials. This is your, this is, at the end of the day, it's something that you need to take control of and you need to take responsibility for. All right. So let's move down here to our liabilities, right? So if I'm looking here at the accounts payable, what am I looking at there? I'm looking to make sure we got all of our bills entered, to make sure that you're getting the credit for the month that they were actually received in. I'm looking to make sure that that number is staying about the same, right? Not growing. If that's growing, what's going on? You are essentially using your vendors as credit. So as that grows more and more, that might mean that you don't have much profitability, but your cash is still okay. But that's going to dry up at some point, because at some point your vendors are going to say, hey, you need to pay us money or else we're not going to give you any more parts. And if you don't have any parts, it means that you don't have any sales. So we're making sure that you're not stretching that out. We're making sure that that's staying in line. It's probably not going to go down to zero, because almost no one, is paying cash or COD. And if you are paying COD, we probably have a whole nother issue there. Same thing here on credit cards. Again, we, strongly recommend our clients use credit cards for any and everything that they can, mostly because of two reasons. First one being is fraud. If we have fraud going on with a bank account, which we see a handful of times a year, and that money gets taken out of your operating account, you might not be able to pay vendors, you might not be able to pay your employees, and both of those people are going to be very upset about it. At some point, the bank will probably get you back your money, but you could be waiting 6 up to 8 weeks for that money to get back. Now, if you're doing all that purchasing on a credit card and they get your Visa number and they charge it up on a bunch of stuff, yeah, it's kind of an annoyance, but you just tell Visa, I'm not paying for that stuff. That wasn't authorized. That wasn't me. There's no money out of your pocket. Your day-to-day operations are continuing on. Plus, the same thing there is we're getting points, right? 2 to 3% back on points. That's just free money. Now, obviously, when I recommend our customers using credit cards, our clients using credit cards, we're not saying carry a balance. If you're going to be carrying a balance on credit cards, if you can't be diligent enough to keep that balance down and pay it off every single month, then maybe it's not the best for you. Because if we're talking 24, 30, 36% interest on these credit cards, you can do the math. Any profit of anything that you're running through that credit card goes away pretty quick because you're paying that much interest. All right. So that's what we're looking through on those two, and that's what I'm looking when I'm looking at these financials. When we come down to payroll, liability, and sales tax payable, we're looking just like we're looking at that cash clear, and we're looking for that number to stay pretty similar, right? On a month-to-month basis, your payroll liabilities are probably about the same. Sometimes it might get stretched out a bit because some payroll taxes are only paid on a quarterly basis or even annual basis. So you'll see the number kind of go up, go down, go up, go down. All right, we're looking for it to not grow. Same with the sales tax, right? You collect it all month, you pay it off next month, but you're still collecting some the next month. So we're kind of seeing it go like this again. At the end of the month, the sales tax is pretty simple. It should match exactly what you collected for that month because that's all that you owe. Once these two things start to get stretched out, we got some really big issues. For any of you, those that have been involved in a sales tax audit or a payroll tax audit, or not even an audit that you just got behind on it, you'll know that they get pretty nasty with either of those. They'll shut you down pretty quick. And one of the reasons that they get so nasty about that is because that's not your money, right? You're collecting the state's money for sales tax, or you're collecting the state and federal money for payroll tax, and you're remitting it to them. Once you start keeping that, yeah, they're going to get pretty nasty and they're going to shut you down pretty quick. All right, so what we're looking at here is, if I'm taking a look at this on the loan, the biggest thing for this loan here is I'm making sure that we're booking the correct interest on it, right? I'm getting the end of year statement as of 12/31/2018 and saying, all right, we have $168,000 showing on QuickBooks. Let's make sure that's on the statement. I want to make sure that I'm getting a deduction for that interest that I'm paying for the year. Again, just like any business, we're looking to be debt-free, so we're looking for the loans to go down. The Snap-on Credit and Great American Finance, you can see here, just the same way I'm talking about, I'm making sure that those are recorded on my fixed asset. I'm making sure that that lease to own is booked on there as a corresponding long-term liability, right? So that about wraps it up for the liabilities. And then what we're going to go down through here is we're going to take a look at the equity section, all right? So obviously we have $81,000. I'm not highlighting that $81,000 because if I want to know how we made that money, then we're going to look on the profit or loss, right? What I'm going to show with this $81,000 is probably the most important question, or most important question that I get is, hey, I made $81,000. Where did that go, right? I hear it all the time, whether I'm going over financials or I'm going over a tax return with a client, and I say, well, we had a pretty decent year. You made $81,000. What are you thinking as a client, or what are they thinking in their head? They're going all the way up here and saying, there's no way I made $81,000, hon. I have $6,000 in the checking account, right? You guys have probably had this conversation with your accountant before. And so what we're seeing here is there's a lot of stuff going on between those two numbers to figure out where that $81,000 went. First place I'm starting is right here. We have $81,000 that we made last year. You took $47,000 out of it in draws. Now, the beauty of being an S corporation is we only pay tax once. So if you made $81,000, you're going to pay tax on it, but it's now yours to do whatever you want with. So this person, he took out $47,000 of those dollars. So we're still looking for $34,000. All right. We take a look here at total liabilities. You can see he paid down $24,000 worth of debt. Went from $268 down to $244. All right, so that's another $24,000. So now we've explained where $71,000 of his money went. The last place I'm looking is up here, the bank account. His bank account went up $10,000. We just explained where that $81,000 went in absolute numbers. Now you can see some of these assets went up, but if you look, it was actually a net zero change. This went up, that went down, and they all kind of canceled each other out. But any time that I'm delivering these financials or I'm delivering a tax return, I'm looking at financials, I'm making sure that it makes sense, right? We're using the balance sheet, and the balance sheet is the dashboard. We're making sure that there's no warning lights that are coming on for our business. The same way, if I'm delivering that $81,000 as the news of what they made, I better be sure that I know where that money went to make sure it makes sense. A perfect example of that is, let's say that we had $81,000. He's showing $81,000 of net income. I call the client up and say, hey, I made $81,000. And they say, where did it go? And I'm looking here, and this draw is zero, so they didn't take the money out. Okay, maybe it didn't go there. I look at the liabilities. The liabilities are about the same, so he didn't actually pay down any debt, so the cash didn't go there. Bank account is about the same, so now we have $81,000. I don't really know where it went. And then we look at the accounts receivable, and the accounts receivable actually went up by $80,000. So what you have is a situation where, yeah, we're going to be paying tax on $80,000, but you have $80,000 extra in accounts receivable. And we see it happen a lot, and they say, you know what, there's no way, I don't have that much in accounts receivable. We need to write that off. Those are all customers that never paid me. If we wouldn't have been looking at that, we wouldn't have been looking to see if that makes sense and track where that cash went, we could have been in a nightmare situation. We're paying tax on $81,000 where we have no cash. Because at the end of the day, cash is king, right? If our business is a car, cash is the gasoline that drives the whole thing. If that cash runs up, that car is going to stop. Your business is going to stop pretty quickly. All right. So that kind of wraps up, a lot of these questions, or a lot of what I would be looking to go down through these reports. And I hope that this is something that you'll look at your own business, because once you start looking at your own numbers, it makes so much more sense of looking at your bank accounts, looking at your loans, looking at your credit cards. I think it'll start to sink in a lot more. The last thing I want to do before I let you guys go is show how to do these same things on the QuickBooks Online as well. So we're going to go over here and we're going to share the QuickBooks Online. Perfect. So just like before, we're going to go over here and we're going to start at this standard column. We're going to go down here to balance sheet. And this is going to pull up the balance sheet for last month. What we're going to do here, just like we were doing on QuickBooks Desktop, is we're going to do here, we're going to click last year. All right. We only want to see rows that are non-zero, right? Like we were talking about before, we're trying to simplify this. We're trying to make it easy to read. Zero accounts are something we shouldn't be worrying about. We don't need to see. And then the last thing here is we're going to click here and we're going to select period. We're doing previous period dollar change. All right. Run this report. Boom. It's exactly like what we were looking at QuickBooks Desktop. Just like we did on a profit or loss, we're going to save this. We're going to save this customization. We're going to call this balance sheet previous year, and we're going to save it. Now, if we go back here to reports, we go to custom reports, boom, we got our balance sheet, we got our profit or loss right there, right at our fingertips. All right. So that wraps it up today. I hope that you learned a little bit. I hope that my analogy of, how the financials relate to your business, is very similar to think about your business as a car. I hope that kind of made sense. And I hope this got you a little bit more interested in your own financials, and it's something that'll be useful for you to use as a business owner. I just want to thank you guys all again for joining me today. And if you have any questions about any of this stuff, feel free to reach out to us. Thank you.